From our Stars and Dogs segment, it's time for this week's Dog.
Yes, the apple of pot stock. So the dog of the week is Canopy Growth Corp, WEED or WEED on the TSX. So the stock is down approximately 21% in the last week, 42% in the past month, and about 85% year to date, where it now trades at about 49 cents per share and has a market cap of about $268 million. So as Ryan said, they were once known as the apple of cannabis stocks. Canopy Growth was a front runner in the Canadian cannabis industry and engages in the production, distribution, and sale of cannabis and hemp-based products for recreational and medical purposes, primarily in Canada, the United States, and Germany. So, driving the losses, the company announced on July 14th that it plans to enhance its financial flexibility and delever the balance sheet by $437 million over the next 6 months and lower annual interest costs by approximately $20 to $30 million. And the company plans to achieve this by settling approximately $193 million aggregate principal amount of its existing notes with a mix of consideration that includes common shares, which is about 90 million shares, and newly issued unsecured non-interest-bearing convertible debentures with a conversion price equal to about 55 cents. Now, additionally, the company will reduce about $100 million of principal indebtedness under the credit facility provided under the credit agreement for a cash payment of $93 million, with the expectation of further principal reductions at 95 cents on the dollar upon completion of certain asset sales. Plus, it plans to convert about 41% of its existing convertible debt into common shares. And on this news, the stock was down 41% as the company will be getting rid of debt, but it will be using both cash and using its shares as currency. So dilution is coming. Shareholders don't love that. Now, let's just quickly look at the company's last financial statements here. First, on the balance sheet, the company has cash and short-term investments of about $782.6 million. I'm not including restricted short-term investments here. As well, debt and leases were about $1.445 billion, providing a net debt position of about $663 million. And because the company posted negative EBITDA of about $350 million for fiscal year 2023, we can't even calculate the company's net debt to EBITDA multiple. So that is a little scary here. So moving on, as you can see, like looking at the income statement here, as you can see, the company's revenue has been declining over the past 3 years. It has absolutely been burning cash uncontrollably while also diluting shareholders quite significantly. And I'll show you here on the next screen. We went from just under 200 million shares in the first quarter of 2018 to now, and this is before the recent announcement where they're going to be converting their debt and issuing more shares, to where they're now just under 600 million shares as at Q4 of 2023. So they've been not profitable. They've been needing to get the cash somewhere. They've been levering the balance sheet, and of course, issuing shares, which makes the company our dog of the week. Any comments, gentlemen?
Yeah, I mean, I think Canopy is the result of a company that had run as a business that never contemplated being profitable. I mean, This is what can happen, worst case scenario. Like I said at the start, Brennan's going to answer whether this stock or the equity can go to zero. I mean, it had a $25 billion market cap basically at its peak, and it's what, 300 million now? I mean, it's basically from its peaks, it's gone to zero already. And equity holders have just lost so much. It may go to actual zero at some point as well. But again, you run a business that, you look at, there was tremendous growth in revenues, never even close to operational profitability. And, anytime we'd even look at it, we did a cannabis sector report back in right before legalization and right at legalization. We couldn't find a company that was profitable to meet our criteria at that point. This company would always be 2-3 years into the future when they would be on an adjusted EBITDA basis, forecasting to potentially break even. Well, it would never meet our criteria. And this is what can happen when you have a business. And I would say from day one, it was just land and expand and grow,
Yeah.
and never contemplate doing that in a profitable manner. Not the type of business that we would look at or ever want to invest in.
I would like to point out here, they don't even have a gross profit at this point. They're losing on their sales. That's really the death spiral at that point.
Pretty much one of the worst financial statements I've seen in a long time.
Yeah, I know. Yeah. It's not even. Yeah, and to be honest,
how many comments though about how we just don't understand the technology are going to be on our YouTube channel?
I remember doing a speech at an event back at the Money Show in Toronto. I think it's probably 2018, 2019, and saying that we couldn't find a company in there. And we did a Q&A at the end, and a louder gentleman stood up and said, "How can you not want to invest in?" And it was Canopy Growth. "How can you not want to invest in that company?" I said, "Well, it's not profitable, and they don't even forecast profitability to 3 to 5 years out. There's a long journey to go from that, where they were then, to actual profitability, to even start to justify their valuations." And he said, "Well, the demand is there. You're a fool to think the demand isn't there." And I said, "Well, if there's an oversupply, it doesn't really matter, right?"
There were 200 cannabis companies publicly traded at the time.
That was just public too.
Plans to expand production to 4 times what the consumption was in Canada. So the numbers didn't.
No, they didn't hold water, and into the U.S. it hasn't held water either. But somebody will be a winner in this space over the long term. Somebody will be. At this case, the equity holders in Canopy will not be the winners. No. I don't think that's a bold prediction at this point.
Even when I was looking and I saw that the company lost in 2023, adjusted EBITDA of $350 million. I'm just like, how? When you're so levered, but again, it's just that trying to get land and expand. When you first looked at
it, did you think you were high when you looked at those?
I'm going into using their product right now.
No, definitely not.